Investing in your 20s versus investing in your 50s. Why would you even think about investing when you're young? Because you still have your whole life ahead of you. You're not thinking about investing, you're not thinking about retirement. You just want to live your life and have fun. You might want to buy the latest video games or even the newest sneakers. And you might also be scared to start investing because you don't know where to start. The investing world is big and confusing, and you might need some help. However, when you start thinking about retirement, the younger you are when it comes to planning your retirement, the easier it's going to be to actually hit your retirement goal. For example, when I was in my early 20s, I worked at a retail store. And this is one of my first jobs that I had. So the company that I worked at had a 401k representative come through in order to talk about retirement and have employees ask questions about their 401k, their retirement, and any other miscellaneous questions they might have. Now, I went into that meeting and I looked around and I noticed that I was the only young person in that whole meeting. So I was in my early 20s and everybody else was in their mid to late 50s and up, which surprised me because even at a young age, I was already thinking about, okay, what do I need to do in order to be able to put myself in a position where I'm already financially free and I would be able to retire early and just live the life that I want to live. That was my whole mindset. But all the young people that I worked with did not have that mindset. They were focused on buying the latest materialistic things such as headphones, new iPhones, and the list goes on. So if you're already thinking about retirement at a young age, you're way ahead of your peers. Now, the people that were in their 50s in the meeting, they felt defeated because they felt that it was too late for them to start investing for retirement. But even at that age, you can still catch up. It's gonna take more effort, but you can still work on your retirement. Everyone's investing journey is gonna be different. But on average, if you're younger, when you start to invest, you'll be able to take more risk. You'll be able to invest in equities or even securities, such as stocks that have historically been able to provide a better rate of return than, for example, fixed income assets like bonds. When you're young, you can invest 80, maybe even 90% in stocks. But the older you get, and when you start hitting your 50s, you want to make that pivot and that switch and start to invest in more fixed income assets such as bonds, annuities, maybe even dividend paying stocks. A good method to use in order to figure out how much of your investment portfolio needs to be in a fixed income asset is to use the John Bogle method. That's an easy method to use. All you need to do is take your age, which will represent the percentage of what you need to have in fixed income assets. So if you're 25, you only need to have 25% in fixed income assets, and then 75% can be in high risk, high reward stocks. Of course, you can play around with this number. Maybe you want to have less than 25% in a fixed income asset. You might only want to have 20%. That's perfectly fine, but just use the John Bogle method to figure out on average how much you need to have invested percentage wise in fixed income assets. And even when you're older, above 50 or 60, you still need to have a portion of your investment portfolio in stocks because you still want that rate of return that stocks can give you compared to fixed income assets. The biggest benefit that you have when you start investing at a young age is that you have a long timeline in order to build and grow your wealth. Because if you start investing at a young age, your capital, your money can compound for you. So the money that you invest, even if you start out by investing a small amount of money on a frequent basis, that money is able to compound. When it comes to your capital compounding in the stock market, there's three ways this happens. It happens with capital gains, interest, and dividends. With capital gains, any money that you've invested in the stock market has the potential to gain in value, which is also called a unrealized capital gain. Now the second one, interest. So if you invest in a fixed income asset, such as a bond, you'll get interest payments on a frequent basis. And then the last one, dividend payments. So dividends that you do get from dividend paying companies, those are going to be reinvested in order to buy more shares of stock. So those three methods of compounding your money in the stock market, that's what's going to make it able for you to invest a little bit of money and your money just compounds and allows you to build wealth. For example, let's say you graduated from college and you started working and you already invested, let's say $2,000 in a 401k. And the company that you work at also gives you an employer match. You have $2,000 invested at the age of 24, and then every single month you invest $1,000, which is doable with an employer match. When you hit the age of 50, you'll be a millionaire if you can get a rate of return of around 8%. Now, if you're at the age of 40 and you still want to be a millionaire by age 50, if you take the same metrics by looking at a rate of return of 8% and you have $2,000 invested in your 401k, you will have to invest close to $5,500 a month just to be a millionaire by age 50. Starting at 24 allows you to invest less because, like I said, your money compounds. But if you start investing at a later age, you're gonna have to catch up. Of course, in your situation, you might not start to invest at the age of 24. And you might not even have close to $1,000 to invest every single month. Everybody's situation is going to be different. But one thing that is important is that you have a investing goal. Because when you start investing, you don't just want to invest just for the sake of investing. You do need to have a goal. Are you investing for retirement? Are you investing for a house? Are you investing just so you can buy a new car? Depending on what your goal is, that's also going to determine where you need to park your money. Investing in the stock market is a long-term investment, so 10 plus years. That's how you need to look at it. But let's say you just want to save up some money for a car or even for a down payment on a house. There are other vehicles out there that you can use. For example, it might just be better to park your money that you are saving to buy a car. It might be better to put that in a savings account or a money market account or a certificate of deposit. But when it comes to investing, try to stay away from the mindset of thinking that it should happen fast because investing is a slow process. Yes, you will hear stories of people becoming millionaires at an early age by just investing, but more than likely they started at a young age and they were consistent with investing a big portion of their salary. It is doable to become a 401k millionaire. You just have to run the numbers in order to figure out how much you need to invest in order to become a 401k millionaire. The stock market is not predictable, of course, but you can look at historical data and, for example, look at the rate of return over the years to figure out and plot how much you need to invest and how long it will take for you to become a millionaire when it comes to investing in the stock market. Another thing that's interesting about investing when you're young or even old is your free time and your investing knowledge. If you're younger, more than likely you don't have the knowledge when it comes to investing in different types of securities. This knowledge comes with time, of course. Time, experience, making mistakes. It's all gonna happen. It's something that you need to take in stride and something that you need to learn from. Look at your failures not as mistakes, but as a learning process. If you're younger, you might have some free time to try, for example, day trading or even options trading. But when you're older, you might not want to participate in high risk, high reward ways of trying to make money in the stock market. And especially when you're older and you're close to retirement age or you're already retired, you don't want to stress over your capital or your money and the value of it going up and down. You want a steady stream of income that you can rely on. So fixed income assets, like I said, will play a major role. Even if you can do anything outside of the stock market, for example, if you have a rental property through real estate, or even if you have a business that provides you a stable, consistent income every month, that's what you need to be building towards in your younger years. And when I think of the future when it comes to investing, definitely investing in the stock market is still going to be the best option. But in the world that we live in now, especially with crypto, I can also see crypto playing a major role in the future in how people will construct their portfolio. So currently you might have some stocks, some bonds, you might even have some commodities. But going into the future, I can definitely also see people and even companies adding more currencies like crypto investments into investment portfolios. Now, of course, anything that you do when it comes to investing, there's risk involved, especially in the crypto market. So definitely crypto will be something that you need to pay even more attention to as it's a lot more volatile than even some of the stocks that you can purchase in the stock market. Now, if you're a lazy investor, if you're more of a set it and forget it type of investor, you don't want to log in and constantly pay attention to how your stocks are performing or how your index fund, ETF, or mutual funds are performing. If you work at a company that also offers a 401k, more than likely you can invest in a target date fund. A target date fund is a retirement fund that automatically rebalances itself the closer it gets to the retirement age. So every target date fund has a retirement age. So if it's XYC target date fund 2065, that means that 2065 would be your retirement age. So when you start investing in this fund now, it's going to be a lot more aggressive with investing in high risk stocks, for example. But this portfolio is automatically rebalanced every single year. And then, of course, the closer it gets to 2065, is going to go from a more aggressive portfolio to a more conservative portfolio. Now, some target date funds, once they hit that retirement age, they either stop rebalancing, but there are some target date funds that still rebalance after that retirement age. Make sure to double check the target date fund that you're investing in, if it's one that does rebalance after the retirement age or if it doesn't. And of course, for this privilege of laziness, because you just invest in it and you don't have to touch it because everything is being done for you, for this privilege, you can expect a higher expense ratio because there is a fund manager that actively rebalances the target date fund, which you will be paying for. Also, if you want to invest in a target date fund, make sure that that's 100% of your investment portfolio. Because if you're going to be introducing other securities besides that target date fund, you're going to mess with your asset allocation. Your asset allocation pretty much telling you how much money or the percentage of money is allocated to a specific investment, whether it might be stocks, bonds, crypto, commodities, art. So, how soon should you start investing? Of course, there's no right or wrong age when it comes to investing, but the sooner the better. Because, like I mentioned earlier, if you start investing at a young age, you have all that time ahead of you for your money to compound and build you wealth. Also, you don't want to put off investing because before you know it, months will go by, years, even potentially decades. And you'll be wondering where did all that time go? Especially if you start making money and you don't invest, you look back throughout the years and you're going to try to figure out, wait a minute, I've made all this money. What did I actually spend it on? When you start investing at a young age, a good way to look at it is that you will be able to make time work in your favor. Because the older we get, the faster time seems to be going. But if you start investing at a young age, you can actually have that time work in your favor. Now, on the flip side of that coin, you might be saying to yourself, I'm way too old to start investing. So, same thing like I said with thinking that you're too young to start investing, you're never too old to start investing. Because if there's a company that you work at and that company offers a 401k, and you also have access to an IRA, you have a higher contribution limit if you're above the age of 50, also called the catch-up contribution limit. This allows you to invest even more than the current limit just to catch up and allow you to grow your investments potentially at a faster rate. Now, let's say that you're very young, you're under the age of 15, but you still want to invest. What you need is a custodial account set up for you. A custodial account can be set up by your parent or a adult supervisor. They're able to open up a custodial account with any of the big name investment firms that we know of, such as Ally, TD Ameritrade, E-Trade, etc. Once you have that custodial account set up, always invest with your parent or your legal guardian. Because especially when you're at a young age, you do want adult supervision when it comes to investing. If you're an older investor or an investor that's already retired, you might be invested in dividend paying stocks. But if you're a young investor, should you invest in dividend paying stocks? Because dividend paying stocks don't grow as fast as, let's say, a growth stock, which has a higher rate of return. Even for a younger investor, of course, invest in dividend paying stocks because if you're young and you're just starting out investing, it's not always about seeing how much money you can make. It's also a learning process, and you want to know the ins and outs of some of the securities that are available to you. And of course, what you want to do is not put all your eggs in one basket. So don't put all your investment money in dividend paying stocks in this case. But make sure that you do have a few dividend paying stocks or even a dividend index fund or dividend ETF in your portfolio. And if you happen to find out that you do like dividend investing, then you can always take it to the next level and start doing some fundamental analysis in order to analyze dividend paying companies, like a value investor would do it. So the mindset that I want you to keep in mind is to start investing at a young age if possible, and then invest any amount that you can, even if it's a couple of dollars here or there. because your money will compound. And then the closer you get to your retirement age and the older you get, that's when you can switch from being more high risk, investing in high risk stocks, to becoming more conservative by investing in fixed income assets. And then once you hit that retirement age, you can dibble and dabble a little bit. Maybe you still want to invest in high risk stocks, or maybe you just want to stay conservative and be focused on fixed income assets only. So let me know what you thought about this topic. Definitely leave a comment in the comment section. Be sure to like this video and subscribe, and I'll talk to you guys in the next one.